Good morning, I'm Guy Johnson. I'm alongside Valerie Teitel. We're an hour away from the opening trade. What do you need to know this Thursday morning? Well, the Fed's cook says she won't be bullied into stepping down. Will her future now dominate the debate at Jackson Hole? After bouncing a little yesterday, tech stocks struggling to maintain the momentum. Markets are very quiet. And Russia's Foreign Minister Sergei Lavrov reiterates that Moscow and Beijing must be involved in any security guarantees for Ukraine. Val.
Not going to lie, there is not a lot of excitement when it comes to this market board standing behind me. S&P futures basically unchanged. We have had 4 straight days of losses, though, for the U.S. equity market. Euro Stoxx 50 futures also unchanged. They have been outperforming the U.S. market this week. Euro dollar also unchanged, 116.50. But dollar weakness has really been a theme this week. It was also kicked off by the recent allegations that Fed member Lisa Cook, which we'll get into in just a moment. U.S. 10-year yield at 4.29, also holding steady. The countdown to the opening trade starts right now.
Thursday the 21st, good morning. There's not a lot going on out there. I'm not going to lie to you. Today's a day when I think we're just going to look for the next catalyst, which could come, obviously, tomorrow from Jackson Hole, could come from what we see in terms of the geopolitical story, but there isn't much today. The market board, as Val just showed you, quiet as a mouse this morning, a church mouse. Very, very quiet, nothing going on. But there's kind of stories bubbling up that I think are really interesting. There's actually, weirdly, despite the lack of news, lots to discuss this morning. Yeah. And Lisa Cook's future, top of the agenda.
Yeah, Lisa Cook's future, the new, target of Trump's ire to the Federal Reserve, let's call it, has been, basically taken aim by President Trump, calling for her resignation yesterday over allegations of mortgage fraud over her various homes in Michigan and Georgia. Lisa Cook out with a statement after this saying that she will not be bullied into her resignation. So she has no intention of stepping down. But I think this opens up a huge can of worms now that maybe every governor, every FOMC member who doesn't vote for a cut in September is going to have their personal lives ripped apart by a lawyer trying to find cause to fire them.
Do we have an independent central bank in the United States anymore? This is the bigger question. And the bigger question as well over the next 24, 48 hours maybe is, does Powell's speech matter, or does Trump's reaction to Powell's speech matter more? Because it feels like the White House is pulling the strings on monetary policy if you look at the market reaction rather than the Fed. And is this the new narrative that we've ultimately got to deal with? And if so, what are the implications of that? Yeah, well, is this story around Lisa Cook going to die, or are they going to file some charges and this going to be taken seriously and push her resignation? That's the big question, because I think we haven't really had a test case over what happens when a U.S. president files a Federal Reserve governor for cause. We haven't really seen that. They know they wanted to attempt that with Powell. That kind of story quieted down. Now they have taken another aim. And this could be perhaps, the next thing to excite this market. Because yesterday we had kind of a mini sell America trade happening. The dollar was weaker. We saw the Treasury front end yields decline on that kind of political pressure. And the equity market was weaker as well. If Trump fires Cook, and we're a long way away from that, and there's all kinds of things that have got to happen. But if Trump fires Cook, do you sell the dollar? That is is it as simple as that? Do you believe that the dollar's exorbitant privilege, this system that has been based on institutional robustness, is starting to fray at the edges? And if so, is the most obvious implication of that a weaker dollar? Well, remember when all this happened around Powell, remember all those reports that Trump had created this paper that he was going to use to fire Powell, this letter. We had the dollar weakened by 1%. The U.S. equity market went down by more than 1%, and Treasuries sold off. Yeah. So that was kind of the blueprint for if this pushes again further. But this could really dominate what happens at Jackson Hole. Yeah. Will other central bankers around the world show up in support of central bank independence? Will they back Fed Powell on this? And will that even make the situation even worse with the Trump administration? Lots of questions, lots of answers required. We're still in the posing question phase. And it'll be interesting the next kind of 24, 48 hours to see what happens. Are tech stocks marking time today because they are waiting for Jackson Hole? Are they waiting to see what happens there in terms of interest rates? In theory, there's an interest rate component into this story. We saw a rally yesterday.
Yeah, or the dip being bought. Okay, the video was down nearly 4% in the session.
Yeah, okay, so there was a bounce off the lows, which today is not carrying on. And is it not carrying on today because people don't believe that bounce has got further legs? Or are traders just waiting for Jackson Hole to get out of the way and then they can start buying tech? I don't know the answer to that question. I'm trying to understand the relationship between the two this morning.
No, I do think people are still scratching their heads trying to figure out what exactly was the catalyst for this tech market weakness. I mean, many people are saying it's just position squaring ahead of Jackson Hole. Yeah. But again, the tech trade is not that sensitive to monetary policy and interest rates. It showed us that previously. We also had these stories that Meta is restructuring its AI division. Wall Street Journal reporting about a hiring freeze. We had that MIT paper saying that 95% of these pilots that these companies have built, these generative AI pilots, aren't driving meaningful revenue. So maybe people are just wanting to hang their hat on the most recent news flow, and it's been negative.
You're never going to get beaten up for taking a profit, are you? So you've had a really good run. Palantir, look at that, great example. Sensational run. The shorts need to get paid. People need to take profit. There is a sort of... These things do go in cycles, and nothing ever goes in a straight line. It could just be as simple as that, as you say. I think the Meta hiring freeze is they've hired a lot of very expensive people recently, and you can't keep doing that forever. A, because I'm not sure there are many people left, and B, because the numbers are just quite exorbitant, and I'm not sure investors are going to be that happy. Yeah, so there is some sort of limit on expenses when it comes to the AI trade. That's what that's showing us. Yeah, very high limits, but yeah. £9 or $9 million pay packages or whatever. Some of the numbers are extraordinary, but they pale into insignificance compared with the hardware spending that is being delivered at the moment. Let's talk a little bit about Russia. Yeah. Everybody got really excited about Steve Witkoff coming back and saying, yeah, Russia's agreed to security guarantees, and we're going to have Article 5-like security guarantees being permissible for Ukraine, and the Europeans are jumping up and down trying to figure out exactly how this is all going to work. Lavrov, big glass of cold water. No, thank you very much. As you were. Any kind of security guarantees, we want to be involved, which effectively means that any security guarantee is not a security guarantee. And significantly, and they've said this before, you pointed this out to me this morning, the Chinese want to be involved as well. We're back to where we started. Has the Russian position really changed? They still want territory. They still want a lot of territory. And they're not really on board with the idea of security guarantees. Was the last kind of week and a half, did the last week and a half actually produce anything new and real? I don't know. He also downplayed any imminent summit between Putin and Zelensky, which I think we knew had some doubts. Maybe we had some hope that Trump, he does have the ability to get people on the same page. You've seen this, what he's done in Congress to pass that tax bill. I guess there was some hope that he could get these two sides together and have a bilateral and then a trilateral argument. But yes, it does seem like this excitement over the security guarantees that we had on Sunday, that was in the markets on Monday, is seemingly not what it appeared. I wonder whether Witkoff's credibility is being questioned here as well. His read on the room when it comes to the Russians will come under the spotlight further from here. And I think, therefore, maybe actually it's going to be interesting to see next time round when he comes out and says they've agreed to this, whether or not the market reacts in the same kind of quite sharp way that it did react to those security guarantee headlines that we saw coming through. Because remember, over the weekend, Witkoff's comments kind of differed from Mark Rubio's, and that was maybe the beginning of some sort of tell that there was a division or someone had misread the situation. Absolutely. What do we got coming up on the show? Alexandra Ivanova, fund manager at Invesco, is going to be joining us. Carole, Nakhle, founder and CEO of Crystol Energy, joining us. What is happening? The story with Russia is really related to what is happening with the energy story at the moment. We'll get into that as well. Willem Sels, global CIO for private banking and wealth management at HSBC, and Jennifer McKeown, chief global economist, capital economics. We have her on because we need to talk about these PMI data. Yeah, that's going to be the key data print today. We have the global flash PMIs out around the world. The European ones drop around 9 a.m., the French ones 8:15, and the German ones around 8:30. So that'll be a key part of the European session this morning. Attention then does shift to the U.S. We have jobless claims this afternoon. We also have Walmart earnings, which kind of ends this big retail earning theme that we've had this week. Had a kind of a missed picture from Home Depot, from Lowe's,
those from Target. So really looking to Walmart, which is one of the largest employers in the U.S. for a key read on the U.S. consumer. And then Jackson Hole does begin today, the Economic Symposium out in Wyoming, with the big highlight obviously being tomorrow's keynote speech from Jerome Powell.
Is it still the highlight? Is that what we're still talking about? I think the Cook thing, just to come back to it, does call into question the bigger kind of picture. Does Powell matter? This is the debate we're having. We've moved on from a world where we pass every single word, like sort of criminology, kind of what is the Fed saying? What are individual members? Tweaks here, tweaks there. We're into a whole new world, a different world, when it comes to what we're watching with the Fed.
Yeah, and then when it comes to the Jackson Hole speech, look, I do think, yes, this political pressure is going to take a big part of the weekend and of the discussion. But remember, we are waiting for an update for what Jerome Powell thinks about the labor market. He previously said it was solid. There has to be a change in language now. Just how steep is that language going to be?
Yeah. Is it still solid? Don't know.
Most people would say not.
The claims data would suggest that maybe it is. What else you need to know this morning? Let me update you. Israel has reported to approve new settlements in the occupied West Bank, while its troops have now reached the outskirts of Gaza City. Earlier, Israel's military called up around 60,000 more reserve soldiers to join the war against Hamas, a sign that preparations are underway for a stepped-up offensive, despite ongoing talks about a ceasefire. After, and we were mentioning this a moment ago, a months-long hiring spree, Meta says it has paused some hiring while it does, quote, planning and forecasting. Considering the amount of money that's being spent, you might have done that earlier. The move comes as part of its latest restructuring of its artificial intelligence division, which will now be split into 4 distinct teams to better capitalise on the new talent that has recently been acquired. And staying in the space, Google has unveiled a new slate of consumer gadgets, including several smartphones, a watch, new wireless earbuds. The product launches are more deeply integrating its Gemini AI assistant with features like Magic Cue and Camera Coach, which provide helpful suggestions and photography ideas. Val's all in, despite the fact it's an Android phone.
Look, I'm really excited about this. I know we've been waiting for ChatGPT to get into hardware, but this is just a good theme that your computer, your phone, your watch is going to have an AI chatbot in it, and I think that's great.
Assuming you're not an Apple customer.
Yeah, I mean, you would have to then transition to a Google
you ready
Pixel
for that?
phone.
I can't.
Which might break my heart, but I think it's an exciting device.
I tried to use an Apple phone the other day. It's just not intuitive to me. Having always used Android, I've really struggled to. So the transition is hard. So yeah.
Yeah, but think of just how overwhelming all of the data on our phone is. All these junk emails, all the photos you take. It'd be wonderful to have an AI chatbot or an AI bot really kind of put it together for you in some way.
Okay, but you've got to go Android to make that happen.
That's the one drawback.
Obviously, Apple will come back with its products. I'm not suggesting that you should make that switch. But I've always been on Android's side of the fence. Coming up, ramping back up, India is again buying oil from Russia after a brief pause, despite facing higher tariffs and criticism from Trump officials. Plus, Oak Tree's Howard Marks says US stocks are in the early days of a bubble. The early days. More highlights from our exclusive conversation with him. Up next, the Jackson Hole Symposium kicking off later today. We're going to dive into what traders will be watching for ahead of that all-important speech from Fed Chair Jay Powell tomorrow. Got any questions? You want to join the debate? IB Plus BBTV Go is the function on your Bloomberg. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance, Friday at 9 a.m.
I've just realised that actually the highlight of Jackson Hole is the place itself and the wildlife and the incredible images that you're going to be seeing. Mike McKee has got a nice gig. He'll be there covering it for us over the next few days. There are obviously headlines that could come out of the event, despite the fact that we're all going to be looking elsewhere at the wildlife. The Federal Reserve Governor, Lisa Cook, says she won't be bullied into stepping down from the central bank. This, of course, after President Donald Trump called for her resignation over allegations of mortgage fraud. Finance Agency Director Bill Pulte says, or told Fox News, that the president had reason to fire her.
She shouldn't be at the Federal Reserve. She's going to resign, in my view, and if she doesn't resign, I do believe that the president has cause to fire her, and that will be up to the president whether he decides to do that or not.
The Federal Reserve Finance Director talking to Fox about Lisa Cook and what happens next. He's got a lot on his plate. It's interesting that this is where he's focusing his attention. We obviously watched last night as well what happened with the Fed minutes. Are these so far in the rearview mirror, and has so much changed since then that actually they are not worth paying attention to? Clearly, there has been a significant shift in terms of the labour market, one would argue. Val's here with more on this story.
Look, Guy, I do agree that these are in the rearview mirror and backward looking, but I think it does give us a good state of play of the recent words that the Fed has given us and how we can maybe juxtapose it to what Powell is going to tell us on Friday, and if there is a big change of language. But in the Fed minutes, it was revealed that a majority see inflation as the bigger risk over the weakness in the labor market. But there also was other hawkish lines given in these minutes. Several saw rates not far above neutral, and several noted concerns about elevated asset valuations. Now, that is screaming not necessarily a scenario you want to be cutting in, and that's why we expect maybe there to be a change of language on Friday when we hear from Jerome Powell at 3 p.m. London time. The front end of the bond market was really not deterred by what we heard in these minutes. It was actually more moved around by these allegations against Fed Governor Lisa Cook. We'll be discussing that more in a moment. But we're still pricing in around an 80% chance of that Federal Reserve cut when it comes to their September 17th meeting. And the attention now very much goes to Jackson Hole and Friday afternoon. I wanted to remind our viewers of just what the theme was for Jackson Hole this year. Labor markets in transition. It does subtly imply that maybe Jerome Powell will be transitioning his views on the labor market. Doesn't it, Guy?
Maybe. Or maybe the labour market is transitioning and he's going to wait and watch and see how that happens. It's going to be interesting to see exactly what he has to say, because there's a lot of expectations and polarisation around that story. Is he going to deliver, or is this all really about the political narrative and his desire to resist the overtures that are coming from the White House? We've seen some data coming out of the UK that's probably worth paying attention to this morning. The UK July budget deficit coming through at £1.1 billion. The median estimate was for a deficit of 2, just slightly better maybe than anticipated. I think the gilts market is a nice little microcosm as well for what is happening more widely, particularly with reference to what is going on in the United States. Which should you focus on? Is it the labour markets? Is it what is happening with inflation? Is it what is happening with politics and what is going on in terms of the fiscal side of the fence? Where should the gilt market be looking? And by extension, can we argue maybe this is where we see the Treasury market going next? Alexandra Ivanova, fund manager at IFI Europe at Invesco, joining us around the table. Good morning.
Good morning.
Do you think there's a useful comparison between the gilt market, where we're worried about high inflation in the UK, and we're worried about what is happening with the labour markets, and we're worried about what is happening with government spending and the size of deficits that we are seeing here in the UK, and what is happening with treasuries? Is one a useful comparison for the other?
Well, I do think that every bond market at this time has its own idiosyncratic stories that are going through, but there are similarities in a way that, for example, the demand for the long end in general has weakened because the long buyers of, say, pension funds, insurance companies are no longer needing to buy super long bonds at these rates, and they're funded. And that makes it kind of a global phenomenon that we see all the yield curves are steepening, be that in Japan, US, or UK. However, UK has its own internal domestic issues. Inflation is quite sticky, and we've seen it yesterday. So there are a lot of noises in there. I think some of the volatile parts of the inflation numbers came in too hot, and for the Bank of England, that makes it quite difficult to make a case for a cut.
Is our central, because of what is happening with inflation, which you could argue is kind of rearview mirror stuff, do you think there's a danger that central banks are going to be late by definition to deal with the labour market crisis? The labour market crisis is kind of creeping up in the background, and then suddenly will kind of jump onto stage and be the central topic. Is that the danger, do you think, that bond markets are focusing on at the moment? Or do they fundamentally believe that actually inflation is going to be the primary issue. It's just a question of sequencing, to my mind.
It is, and when you look at the terminal rate that is priced in the market for UK, it's around 3.6 to 3.7, I think. And you could argue that UK, relative to US, is much lower potential growth, lower productivity economy. So the traders in the market is assigning much higher premium for that stickier inflation.
Isn't there the danger here is that you have high inflation, which means the central bank can't cut, which means lower growth.
Yeah.
It's kind of, that's the pivot.
No, I mean, I think that's what the gilt market rally told us yesterday. We saw a big bull flattening in the gilt market, and it really stood out to what other bond markets were doing around the globe. I mean, how do you explain that? Is that what you're reading through, that in some way Bailey is going to force an economic slowdown to get rid of inflation? Well,
I mean, there are some commentators who are arguing for some kind of reset in the economy, and that might need to come from some short and sharp recession. But I do think that there is also the supply and demand element to it, and it has been quite a tricky year so far to invest in gilts, and when we see global bonds rallying, gilts tend to lag. When we are selling off, gilts tend to sell off more. But to me, it looks like we are getting to some kind of exhaustion, meaning, we don't have a lot of sellers at the moment. And even if we surprise to the upside, the market is starting to feel like maybe we are getting to the extreme levels of the yields and very low prices. So I would say that maybe at least from now on we trade sideways. And then we wait for what happens in the autumn statement. Yeah, okay, so that's the state of play when it comes to sovereign debt. But what's your view on corporate credit and corporate debt? I mean, we had earlier this week, we had credit spreads, at least in the U.S., investment-grade credit spreads, reach the tightest that they've been in 30 years. We've seen similar kind of moves here in Europe. How do you justify credit spreads where they are right now? Well, it is a head-scratcher, and I have seen some strategists actually bringing their forecast even tighter from where we are at the moment. And the way I think about it is overall yield and overall cost of debt for the corporates, it's not necessarily that high. But at the same time, we have the core yields that are much higher. So if you are a multi-asset portfolio manager, you have different asset classes, right? Yeah. The rates are relatively attractive, but the spreads are very, very tight. But fundamentally, credit is much stronger than sovereign debt. For example, credit corporates have been more proactive in managing their balance sheets. Yep. The leverage has been coming down. They are much more profitable. Of course, if we see some weakness in the economy, that might change. But so far, we haven't seen much of that. How big a change could that be? If you're buying for yield, not for price, I do wonder how quickly all that could shift. How quickly could the credit market change? If in a recession scenario, how mispriced do you think the credit market looks? So my personal view is that not much. The reason being that if we do get a recession, where would the core rates be? At least the front end. Let's stick with the front end of the credit curve and the bond markets. I think in that scenario, you will see that the Fed, Bank of England, cutting aggressively. That means that the core rates will rally quite significantly, and your spreads would widen quite significantly as well, but it could be just wash in the price action. So then you're still getting your carry. Yeah. All right, thanks to Alexandra Ivanova, fund manager for IFI Europe at Invesco. Coming up, India ramps up buying Russian oil despite U.S. criticism. We'll discuss with Carole Nakhle from Crystol Energy next. This is Bloomberg.
30 minutes from the start of opening trade here in Europe. Let's take a look at how equity futures are faring this morning. There is not a lot of action. We do have NASDAQ futures, though, slightly in the green. So that rebound in tech stocks is continuing. Euro stocks futures, though, are in the red, down 0.1%. FTSE 100, let's call that flat. CAC just slightly in the red as well. Let's take a look at European fixed income at the open. There was a rally yesterday, around 2 to 3 basis points across the curve. Germany 10-year yields unchanged this morning at 271. The big theme, though, this week has been the breakout in the long end of European government bonds. Some of those yields are reaching decade-long highs. A lot of questions on what exactly has been spurring that move.
Got PMI data coming up. Maybe there's some movement that comes after we see that data. We'll wait and we'll watch and bring it to you live as it hits our screens. Let's talk about what is happening in the crude market, the energy space. India has returned to buying Russian crude after a brief pause. That's despite the country facing higher tariffs for trade and criticism from Trump officials. Meanwhile, oil held gains after US crude stockpiles shrunk the most since mid-June. Diesel demand very strong at the moment, it seems, which is interesting. That kept inventories below seasonal averages. Joining us now, Carole Nakhle, founder and CEO of Crystol Energy. Carole, good morning. Is it the Ukraine story that is driving the energy market at the moment? And how much clarity is the energy market really operating, therefore, with?
Absolutely. I mean, we always sit down and try to figure out what is driving oil prices and looking at different fundamentals and geopolitical factors. But today, for me, the main driver is crystal clear. It is the negotiations, the ongoing talks about the Ukraine war and the potential for a ceasefire between Russia and Ukraine. And you can see it clearly. So if you're following oil price movements, you can see how the market reacts as soon as there is certain new announcement, a big, beautiful announcement about the negotiations. But then it goes quiet and the whole momentum fades away. So this is really the main driver. But overall, if I look at what the expectations, the main consensus today, it seems that people seem to be expecting some kind of deal to happen. But honestly, from the way I look at it, I don't think anybody knows where we're heading. And this is why perhaps we're seeing the market reaction. Yes, we are seeing some movement, but we remain in a pretty well-defined corridor. Or it could be that actually nobody thinks that something big is going to happen and the situation is going to continue where we are today. Yeah. But it would be very interesting to see what the outcome would be from those negotiations, because that in turn will have a big impact on markets.
Okay, so it would be, so if there was a peace deal, there would be a big impact. Is that what I'm hearing you say?
Well, I tell you, the big mistake, and it would be really naive and simplistic to believe that if there is a peace deal, then the market is going to be flooded by Russian oil, because Russian oil never left the market. It has always been there. It has been going to different clients, including particularly India. So in that respect, we should not expect the market to be flooded. We're going to see, of course, the Russian economy will benefit because the Russian oil has been selling at a steep discount, especially today more than before because of the latest European sanctions, and also the fact that you have secondary sanctions, a threat from the US, which pushed Russia to offer bigger discount to its buyers like India. But the key problem would be for the market, for consumers in particular, is if no peace deal is achieved and President Trump imposes or acts on his threat of severe sanctions on Russia and effective implementation of secondary sanctions, then we're going to have some supply losses from the market, and the market will take notice in that respect.
Carole, in that kind of situation you just outlined there, where do you see Brent trading?
I mean, you can look at it like a glass half full or half empty. So people saying that Brent today is pretty low. Actually, I think that given the existing situation and the fact that OPEC Plus has released 2.2 million barrels a day quite rapidly into the market in a matter of few months, I think for Brent to be trading in the range of the high 60s to low 70s is pretty a good sign. It means that the prices are holding up quite well. So yes, OPEC Plus did not, if they did not release their barrels, we would have seen a much tighter market, but they did not crash the market either. So for me, I think the prices to be where they are today tell us that the market is not, is rather in a certain balance. It's not oversupplied, but it's not undersupplied. So it's holding up pretty well. Where it's going next depends on really who you believe in. So far, the the consensus is for a supply, a market comfortably supplied, to quote the latest report from the IEA, whereas it seems that OPEC continues to be the most optimistic when it comes to oil demand forecasts, maintaining their tradition from last year. And really today they are expecting double the demand growth compared to the IEA and also for next year. But I would say that the majority, given last year's experience and number, seem to be subscribing to the IEA numbers, and that's why we are seeing lots of lower forecast for oil price, even in the 50s, from some major institutions, forecasting agencies.
Carole, I guess a bigger downside risk to oil might just be around the likelihood of a global economic slowdown, around how the U.S. economy and others are dealing with tariffs. What kind of numbers have been floated on the back of perhaps seeing evidence of a slowing global economy?
I think we had earlier this year a big shock when the tariffs were announced and the big numbers were announced and how they were imposed on a very large number of countries. And this is where we saw economic forecasts from the World Bank, from the IMF and other institutions and organizations drawing a more pessimistic picture about global economic growth. That picture has not changed drastically, but it has not worsened. On the contrary, I saw some moderate and modest improvements in the forecast, as if the initial shock of the tariffs has been absorbed. And mind you, we're still in rather unknown territory because, yes, some deals were achieved with some countries and some regions, such as the EU, but we are still guessing what will happen with other players. So it's not a fait accompli yet, but it's not as bad as perhaps people expected earlier this year. Mind you, for instance, today when we saw the latest slight uptick in prices and the drawdown in inventories in the US because of the travel season, that kind of tells me that the American economy is not really in bad shape. So it's not as pessimistic as people expected at the beginning of the year. But again, the jury is still out on the impact of tariffs once we have the full clarity on who is going to pay what and when and how much.
Carole, and how much? What would a peace deal mean for European gas? Because energy prices remain high, and I'm wondering whether that will be where the change may come from.
I think for me, the gas story, especially in Europe, is much more interesting than oil. And it did not unfold suddenly because Europe was always the biggest buyer of Russian gas, and they had a decade of relationship connecting pipeline. But then suddenly after the war in Ukraine, we saw this kind of changes, some drastic changes in the relationship, but Russia managed to compensate for some of the losses of pipeline gas by sending LNG to Europe. But for me, Europe is an interesting market, not because it is growing. Actually, even before the war in Ukraine, it was barely moving, whereas Asia is the interesting market from the demand growth perspective. But the way I find interesting is the competition, because the biggest competitor to Russian gas was and still is and likely continue to be US LNG. So that when you look at the players in the European markets, they change drastically, structurally. What will happen if a ceasefire or a peace deal, more importantly, is achieved? Will Russia reinstate its relationship with Europe in terms of selling gas via pipeline, or will they continue to expand with LNG to give them the flexibility and stronger negotiation, especially when they lost Nord Stream? And what will the Europeans do? Are they going to put back some trust in Russia, or are they going to continue to buy from elsewhere, especially with the tariff deal with Trump? Energy plays a central role in terms of selling LNG to Europe.
Be interesting to see how the German economy would react to cheaper energy and how that would impact some of the data that we're watching at the moment. Carole Nakhle, founder and CEO of Crystol Energy, thank you very much indeed. Aliko Dangote, Africa's richest person, has built a $20 billion oil refinery in Nigeria. So that, just by way of context, is bigger than any that we currently have in Europe. Critics are questioning, though, whether his dominance will truly benefit the nation or mainly just enrich himself as he seeks to ban foreign competition within his country. Let's talk more about this and what is today's Bloomberg Big Take. Our chief Africa correspondent and anchor, Jennifer Sabasaja, joins us now. Talk to us about the significance of this refinery. Obviously, in some ways, it frees up the Nigerian economy from dependence on external refining. It allows Nigeria to be much more independent, but it also gives Dangote a huge amount of influence.
Right, Guy, and I think many people who are looking at this story do look at it through both of those two lenses. But I don't think we should understate just how significant it could be for Nigeria. If we take a look at just what we've seen with the economy over the past few years, it's Africa's biggest oil producer, the most populous country within OPEC. And yet for decades, it's had to rely on exporting barrels to Europe and elsewhere and having to import them back and then having to rely on and actually turn to things like fuel subsidies, also having corruption and theft being into the mix. And so for Nigeria, as you were just mentioning there, Guy, it does potentially give the economy for the first time in 3 decades an opportunity to actually export refined products. But again, as our big take does note today, it has made Dangote even richer than he already was. Actually, since we have seen the facility actually come online, he has in the past 3 months, his wealth has grown from $1 billion to $28 billion, as this full screen is just showing. And that is coming, as you were just mentioning, this is a $20 billion project. It took him over 11 years. He frequently had to deal with the government and inadequate policies and infrastructure in the mix, as well as consumers and constituents being upset about the displacement. And yet he's able to get this through the mix. But it's not where he stops. He still has his eyes set on a lot more refining capacity and also is looking to other commodities potentially. But then many people, as you were just noting there, Guy, are wondering, does this mean Dangote continues to have a tighter grip on the Nigerian economy? Or is this really going to see Nigerians actually benefiting from these refined products?
Jen, what's next for Dangote? Is he aiming to build even more refineries or expand his capabilities? What's on his plate?
You know, his expectation, Val, if you speak to him, is he wants Africa to be able to continue industrializing. He's been in the commodity space, though, for decades. His family has been in it for decades. So now that we have seen the oil refinery up and running to a certain extent, he does want to see the capacity continuing to grow. He's also, though, looking to his fertilizer plant continuing to grow. And our reporting suggests that he's even sought a permit for the biggest deep sea port in Nigeria. So clearly, he does have a lot more plans to continue to expand and grow his empire. But if we take a look at how he made his first billions, which is the cement business, he has recently stepped down or decided to retire as chairman from Dangote Cement, naming a former EcoBank executive to the ranks, but still likely to be very involved, as well as his daughters, in the business and in his growing empire.
Jen, final quick question. This was something that caught both Val and my eye yesterday. Kenya is in talks with China to convert dollar loans into yuan loans. How significant a move is this? And is this something that could be replicated elsewhere? There's clearly a kind of push by China to de-dollarize. How big a part of this could this be?
You know, Guy, this is really for Kenya very important. If we take a look at the infrastructure and how they've been able to finance their infrastructure in the past few decades, they have relied on China quite substantially. And so now over the past few days, they've been in Tokyo for this Japan-Africa summit. And our understanding is that they're actually talking about having some yen-denominated bonds. Potentially, that could open the door to expansion for the government, which has actually had a difficult time finding diversified economic sources. They tried to raise their own taxes, and we saw how that played out on the streets with Kenyans. And so potentially this opens the door for them to have another option. We've seen similar efforts by the likes of Ivory Coast, which also did have a $50 billion yen-denominated bond. But potentially Kenya can look elsewhere outside of China, potentially to Japan. Now, the only question marks, though, we have is what are the terms going to be and how much exactly? Because we did hear from President Ruto saying that he does want to strengthen ties between Japan and Kenya. But we know that Kenya has been in its own economic situation, given a number of the loans, the billions of dollars in loans that it owes to the likes of China. So potentially then that frees up a bit of space for them if they are to focus then in on a yen-denominated bond. But we still need to get a few more of the details. But we could could potentially see other African countries doing the same as we see more African countries in Japan speaking about deeper economic ties between their nations.
All right, Bloomberg's Jennifer Zabazaja, thank you for joining us, taking us through some of the recent developments in Africa. Coming up on the show, we'll be watching two of France's biggest banks today after they got caught in a downgrade at KWB. We'll talk about that and other stocks to watch next. This is Bloomberg.
I'm assuming the coffee shops of London are doing great business this morning and that everybody's out getting a early morning shot because nobody seems to be at their desks, or if they are at their desks, they don't seem to be doing a lot. The data I'm looking at on the screens this morning is very unconvincing in terms of a sense of direction. I'm being polite here. Basically, nothing's moving. Nothing's moving. The rumour has it, though, that Mark Cudmore is excited about Indian and Australian PMI data. Let's confirm this story now and try and figure out exactly why we are so excited. Update us, enlighten us, Mark. Good morning.
I think you've set the scene pretty well there. I am scraping the bottom of the barrel here, I admit. But I did just notice that both the services and manufacturing components, and therefore clearly the composite PMI reading for both India and Australia, were at multi-year highs. And I thought it was just interesting, given the negativity around global growth at the moment. India in particular is meant to be right at the target of the US trade war, and it hasn't been backing down, is suffering from great tariffs, and yet both the manufacturing component and service component surged again. And so this global resilience story continues to go on. I should kind of give the disclaimer that the market wasn't even excited in real time. Maybe they all missed it too. They're not used to these being big market movers, and maybe that shows just how much we're kind of scraping the bottom of the barrel, because there isn't a lot of excitement today. The backdrop is very exciting though. It's only because we're on pause, because there's a couple of big dynamics in play, and that's the fact we continue to see long end yields around the world go higher, and that's into this big key Jackson Hole meeting this weekend, where I think the risk is for even higher long end yields. So I think that's a very interesting dynamic. We've obviously got tech finally weakening, which has been the whole story higher, and that goes into Nvidia earnings, the key name next week, which we expect to be beat. We expect to be super strong earnings. I don't think it's going to save AI. So I think that those dynamics are really, really big, and I think there's an interesting background story. It's just the major catalysts to move us on next are unfortunately not coming until Friday.
Well, Mark, talk us about the price action yesterday in tech, because NVIDIA was down nearly 4% during the session and basically made its way all the way back to flat, closing down just 0.1%. Do you read that as a bullish fundamental that this tech dip that we have seen for now nearly 4 days straight could be bought ahead of Jackson Hole?
No, I don't particularly. I wouldn't read it as anything that's been overly bearish just yet or overly bullish. It's just choppy. The fact is, we know we have a couple of key drivers, catalysts, coming up in the next few weeks. It's not just Jackson Hole, it's not just Nvidia earnings, but then of course we have that jobs data. We want to kind of, given what a shocking NFP we had last time, we want to see whether this follows through. And then of course we have a CPI print when we know we've got a growing inflation problem that's broadening out before the September FOMC. That's the next 4 weeks. There's so much to react on, so it's just choppy at the moment.
Okay. Today we'll take it easy today, but there's news coming, I promise. I hope so. If Trump fires Lisa Cook, do I sell the dollar?
It's a great question. We didn't really answer this morning. I think the knee-jerk reaction is absolutely, because even if she was at the more dovish end of the spectrum, it's still seen as more interference in central bank policy. So the instinct is to sell the dollar. Now, I think probably people that qualify that after a little bit, it doesn't sell off too much. But ultimately, we know that every replacement is still going to be in the dovish vein from here on out. So all these catalysts around the Fed pressure are ultimately dollar negative.
All right, that was Bloomberg's Markets Live editor, Mark Cudmore. And remember, you can get up-to-date analysis and insights from Mark and the rest of the team. Just go to MLIV Go on your terminal. Now let's get your stocks to watch with Chloe Melly. Chloe.
Good morning, Valerie. Let's start with UK home builders this morning. And we might see a little bit of weakness in the sector after some data from Knight Frank that shows that those home builders are really delaying, putting off projects for longer and longer after receiving permits. So we could see further weakness there. We already have had quite a tough year, especially for Barratt Redrow, which is the biggest home builder in the country, and also Taylor Wimpey, which is down about 18%. This obviously does not give much confidence in the outlook for that market. And the person behind that data from Knight Frank said that this was really a new low for the market. So definitely something to keep an eye on today. Moving on and going over to France, where we have got a downgrade for both BNP and Crédit Agricole this morning. Both of those have been downgraded to a underperform rating by KBW. They've both had quite resilient second quarter results, but if we look at the performance against the wider sector benchmark, we can see that they have been underperforming, and that gap has been widening further and further. So we'll see how much this downgrade moves the needle at the open. And finally, let's end with Aegon. So Aegon, the insurer, reported quite positive results this morning. We have got a profit that beat estimates and an increased buyback. The shares have already been doing quite well after obviously a massive dip in April, but they are up about 12%, 12.5% year to date. So we'll see if we get an extension of that gain on the back of those results this morning.
Great stuff. Thank you very much indeed. Keep an eye on what is happening with UK house prices and the feed through into the house builder seems to be the narrative right now. It's a quiet. I'm joking about it being a quiet market. It is a Thursday. You've got a lot going on coming up later on this week. In some ways, you can understand why traders just want to wait and watch, because actually there's some really quite big events on the horizon. Jackson Hole is obviously one of the main ones we're going to be watching tomorrow, but Nvidia's coming up next week. It's not as if we are short of catalysts right now. They're just not here right now, but they are coming soon.
And I mean, add that into this, this building pressure on the Federal Reserve. Will Lisa Cook resign at some point over the next few days? Will Trump attempt to fire her? That's going to be another key thing for the market reaction.
How does the market react to that? If he fires her, this feels like a big event.
Well, it also could be a blueprint for doing so for other members. Precisely.
Once you've done it once,
makes it easier.
Makes it easier. Does Powell come into the firing lines, despite the fact what the Supreme Court said? The implications of this go way beyond simply.
Screams Fed cuts to me. I don't know about you.
Yeah, but are those going to be taken well, and what happens to the long end of the bond markets? The opening trade is next. We are 5 minutes away. This is Bloomberg. Thursday, the 21st of August. A quiet session. Expected. Let's talk about yesterday, though, which was a little bit more exciting, actually. European stocks actually rallied quite nicely. US stocks initially dipped, but then rallied quite nicely into the close as well. We're kind of holding ground this morning. Futures are giving us very few clues as to kind of what happens next. The catalysts are coming, but they're not here just yet. It's going to be Powell at Jackson Hole. It's going to be Nvidia numbers. It's going to be what happens with Lisa Cook's future. All of these questions are out there. I'm not entirely sure we're going to get as much clarification today. So that's what yesterday looks like. Let's talk about today, give you an idea of how that is setting up. And as you can see, Eurostoxx futures are mildly negative. FTSE 100 futures are mildly positive. FTSE's been one of the quiet stories in the background, high after high after high throughout this year, and it had a decent rally yesterday. DAX futures down a fraction this morning. Futures aren't giving us much of a sense of direction right now, but there's a few single stocks out there. Val's looking for a catalyst, and I think she's found one.
Looking for a catalyst? I got one for you. It's an organic catalyst company. They make biochemicals and enzymes. That's Novonesis. They outlined their 2030 targets. Growth is looking good, so that's one stock in the Netherlands we'll have our eye on. Also, Aegon in the insurance space. Operating profit came in strong. Lastly, UK home builders. London delays. You also have the Chancellor talking about raising property taxes, so that one will also be under our radar. Guy.
Absolutely. We're going to watch all of that as we work our way through this open. It is Thursday. There's lots of London XD in the market as well, which you need to bear in mind too. So you're going to be thinking about that. But a quiet session. People are watching. People are looking for maybe things that are going to move this market in one direction or another. But today, it's just not clear that we're going to get the answers to that question. So maybe a flattish open in prospect. Let's find out. It's time for the opening trade. These are the numbers I have for you. This is the direction we're moving in. And at the moment, as you can see, we are moving. No, the FTSE 100 just went through a phase there. Did you see that? Of zero either side. Basically, we are moving just a few ticks either way. The Stock 600 is absolutely flat as a pancake. It is not often you see a market open where the Stock 600 at this point actually actually just has zeros. And there you go, there's the FTSE 100, just with zeros. The IBEX is moving a staggering 0.01% to the upside. The DAX is moving in the opposite direction. Everything seems to be balancing out nicely. At an index level, I am struggling, Val, to find much sense of direction and much to talk about. So I'm going to hand things over to you to give us some excitement.
Well, when it comes to the sectors picture, we are looking fairly balanced. We have around 8 sectors in the green, the remaining 12 in the red. At the top of the basket, we are seeing energy stocks perform the best. Vestas Wind Systems actually driving a lot of that gains. To the downside, we do have sectors like media, but I do want to note one of our stocks to watch, Novonesis, that we thought could actually rally on some better growth targets, is actually the worst performing stock this morning, down over 7%. This is an enzyme company related to the pharma space in the Netherlands. A negative catalyst there for Novonesis, down 7%. But the sectors picture at the moment is increasingly turning more red across my screen. We only have 4 sectors now in
Anglo's XD, AIB's XD, Babcock's XD, IHG is XD, Legal & General is XD, Schroders. There's a whole raft of others as well that are all ex-dividend this morning. So just bear that in mind when you look at the numbers.
Look, I thought broadly this week we would have European stocks outperform because of the better-than-expected Russia-U.S. meeting in Alaska, but that's turned out to be not necessarily the catalyst. But overall, European stocks have outperformed U.S. peers this week, and a lot of that is down just the weakness in the tech trade.
So it's interesting that Shell is up, so you can argue that if you are reading the Ukraine story now as more negative, you would think that oil prices potentially could go higher. We were talking about this earlier on the show. So Shell is tracking a little bit higher. It's up by 1%. So that's interesting. Interesting that Rheinmetall this morning is a little bit higher, maybe also indicating maybe that the conflict is likely to continue, maybe in its current form. Rheinmetall is up by 1%. Rolls-Royce is tracking a little bit higher. BAE Systems reacts a little bit to the upside as well. That's where the move is coming from if you're looking for some positivity. Positivity maybe is the wrong word, but it's maybe actually the Lavrov comments, this idea that actually there are going to be no security guarantees that are going to work realistically, that the conflict is going to continue likely in its current shape. That would certainly seem to maybe being priced into the market this morning.
Yeah, still a lot of questions on the security guarantees and then how they would feed their way into the European equity market is obviously still a question as well. But joining us now is Willem Sels, the Global CIO for Private Banking and Wealth Management at HSBC. Thank you for joining us on this snoozy August Thursday, we'd like to call it, but inject some excitement around to this table. How are you thinking about the AI trade? Because I think that's really captured a lot of the interest when it comes to the global equity market this week. The hit that NVIDIA took in the session yesterday that was bought. How are you thinking about this negativity and where it's come from?
Stick with the AI trade, because we're going to have the combination of that AI liftoff, which we're seeing across industry and the real economy, as well as the Fed rate cuts, which obviously are going to support the growth stocks. It's natural ahead of Jackson Hole, where a lot of the rate cuts are already priced in, very high expectations together then with the NVIDIA results coming later, that the market is a little bit wobbly here. Yeah. There was a lot of chatter over the last few days about value versus growth and how much growth had, outperformed. So I think it's not surprising that we have a little bit of a profit taking. But I do think that, you need to stick with that AI trade, but basically broaden it out across the ecosystem. So that includes the infrastructure. It includes even the energy provisioning for all of that. And that's what our clients are doing.
Look, Willem, I do agree that there does seem to be profit taking, at least on momentum type trades. But overall, tech is quite resilient to monetary policy. So why would you be taking tech off the table, given it's maybe less likely to move if we get a surprise from Jerome Powell on Friday?
So given that a lot is priced in, I think, in terms of those rate expectations, if we don't get it, then, obviously growth stocks could potentially see a little bit of a hit. But I do think that ultimately, number one, we do think that you're going to have the cuts. Yeah. Number two, I do think that you need to look at the earnings picture, where now actually expectations looking ahead, because companies have done so well, the growth figures in terms of earnings growth for analysts for the tech sector are actually reasonably low. The Max 7 in particular reasonably low, and we could have positive surprises. And then, the fact that this is spreading across industries and therefore gives you a lot of opportunity to sort of widen that trade, even also into China, right? Because a lot of the AI companies, tech companies, they are trading at 30-40% discounts.
How would tech do it at a recession?
So a lot of the tech companies are seen as quality companies, and that's how they have behaved over the last number of quarters. So I do think that
at current multiples.
You could potentially, well, you have the shrinkage in terms of sort of multiples coming from the growth side, but then if you are looking for lower growth and therefore then have lower interest rate expectations as well, that could offset it. You would have probably a little bit of a dip in multiples, but not extremely so. You would probably still be better off in tech than in a lot of the other industries.
On a relative trade or on an absolute trade? Okay. What questions are your clients asking right now?
So market narratives change, and therefore client questions change as well. So there were a lot of questions around erratic, policy making, around the debt pile, therefore around de-dollarization, and therefore do I need to flee from the US? And so we've seen that in the data that people have not fled, right? There's been a little bit of a dip in bond buying and equity buying, but not a huge amount from foreigners. Now the story has changed a little bit, and it's about, well, the US is dominant, 2/3 of the equity market. Tech is dominant within the equity market, and then you have US dollar weakness. So for other reasons, we need to kind of diversify. Again, not flee, but diversify. So
because of the dollar weakness.
Because of the dollar weakness, the fact that you own, as any investor, if you buy the market, you own a huge amount of tech, you own a huge amount of the US, and you have a US dollar weakness. So I'm just very exposed to that trade. Do I need to actively diversify? That's the kind of question. And so I would say from a sector perspective, certainly diversify into financials, into industrials as well. Industrials also benefiting actually from the trade, so not completely uncorrelated. From a geographical perspective, we do like China, Singapore, and UAE, small market. And then obviously now, there is a reason to start to diversify more into bonds again. People have been sitting on cash. It was comfortable and it was reasonable as the Fed was in a wait-and-see mode. But as we now are coming really to the next, interest rate cuts, you need to start to lock in, those bond yields. And we're starting to really see those flows now.
Are you talking about sovereign bond yields, or are you pushing clients into credit?
Quality. So, private clients will typically prefer investment grade for that little pickup, as long as they're comfortable, it won't widen too much. The real discussion, though, is how far do you go in terms of duration? And as the curve is very flat up to the 5-year point, it's really, interesting to try to pick up, a little bit more duration than that. So maybe do a little bit less in terms of notional value, but go beyond the 5-year point.
You mentioned you also looked at diversifying into China. China tech stocks something you're willing to take a look at these levels?
Yeah, I do think that they at these levels 30-40% below other markets, and I do think we are starting to see also now from Western investors more flows into China. We're seeing that in the industry-wide data as well, but we are seeing it in our business. And that is in part because they see all of the tech innovation and the valuations, and they're looking for, and that diversification from the US, but also this topic which we all hear a lot about, I think the anti-involution, the supply side reforms, because a big reservation from foreign investors had been the deflationary forces, overcapacity leading to very low margin power for companies. Is addressing overcapacity going to lead to higher earnings expectations and therefore more sustainable upside? Clearly, people are still underinvested. So if those flows go in, it can push the market up.
Does the US equity market need rates to be cut to maintain current levels and continue to push on from here?
I do think so. Yeah, to some extent that we do need the cuts. We have 3 cuts penciled in for September, December, and March.
Right.
You have quite a high real yield, both compared to other markets, right? Compared to the UK, compared to Japan, compared to the Eurozone, different economies, I know.
Sure.
But quite a significant real yield, both on the policy rate side and on the 10-year Treasury as well. So I do think that you can have a number of rate cuts while still remaining in a restrictive, monetary policy environment. Obviously, then the market turns that into, quite generous financial conditions by being, having such tight spreads and such low volatility. But I do think that the Fed can cut it a few times.
Willem, nice to see you. Thanks for stopping by to see us. Willem Sels, Global CIO for Private Banking and Wealth Management, joining us from HSBC. Quick look at what is happening in Europe. The answer, to be honest, is not a lot, and you can see that on the screen in front of you. A little bit of weakness coming through maybe in Nakhle. There's a few XDs out of the London market. Defence is coming back, and I do wonder whether that is related to the comments we've seen from Sergei Lavrov, indicating maybe that actually any kind of security guarantee for Ukraine is going to be hard to produce and make work with current Russian views on that subject. LVMH is a little bit softer, down by 0.7%, and you've got not much else happening elsewhere. But Chloe Melly is here with some details of things that are moving. Chloe.
Good morning, Guy. Let's start with Aegon today. So Aegon reported operating profit that beat estimates by quite a large margin this morning, and it also increased its buyback. So that is leading the shares up this morning. We're up about 7% for the insurer, so quite a good day for Aegon. Moving on to defence. So defence stocks have been going up or down depending on what the market sees as the likelihood of this peace deal in Ukraine. And at the moment, it seems that this potential peace deal is looking a little bit more unlikely, and that is driving the shares of those defence names this morning. So Rheinmetall, Hensoldt, Leonardo, BAE, all in the green this morning, which is a reversal from what we saw yesterday. Moving on to Safran. So Safran is an engine manufacturer. It's also a little bit exposed to that defence trade, but it's mostly up on the back of an upgrade from Bernstein, which said that there was really a great aftermarket performance, and this aftermarket segment has really been driving the earnings over the last few quarters, and it seems like that will be continuing for Safran. So we're up about 1% this morning. Moving on to CTS Eventim. So this is a bit of a smaller company. It is in the ticket business, so tickets for concerts, theatre, sporting events, and it reported profit that missed estimates this morning, and that it's not being rewarded by the market at all. We are down 17%, so a major underperformance this morning, and perhaps a little bit of an indication of this live entertainment sector having some tough times ahead. And finally, Novonesis is also down. We thought it might be up, maybe perhaps on the targets for 2030, but those may have disappointed the market this morning, and the enzyme maker is therefore down.
All right, Chloe Melly from our equities team, thank you for the update on the recent movers 12 minutes into the equity session. We also have some headlines around Zelensky we want to bring to you. He has been speaking to reporters, saying he sees positive signals the U.S. may join security guarantees. Guy, I know we were just talking about the Russia's side of the view on that situation.
He's ruling out a meeting in Moscow with Putin. He is ruling out Hungary as well. He sees Switzerland, Austria and Turkey as possible venues for such a meeting. Remember that the Russians, to a certain extent, are kind of backing off that idea that you could see a Putin-Zelensky meeting. Peace talks should take place in neutral Europe. He's sort of, I would say, maybe being a little bit cautious in terms of managing expectations around whether or not this meeting will actually take place. The more that's ruled out, the harder it is to rule things in.
Well, they're talking about a location. Maybe that's a positive signal in itself. No?
Maybe.
Guy's still underwhelmed on the situation. But coming up on the show, Oaktree's capital Howard Marks says the U.S. stocks are in early days for a bubble. We'll hear more from our interview next. This is Bloomberg.
French PMI data breaking onto our screens right now. 49.8 is the comp number, up from 48.6. So basically we're at the flat line on the French data. This is the line you have from market PMI markets as they produce these numbers. After a sustained period of contraction in the Eurozone's second largest economy, August flash PMI data showed signs of stabilizing business conditions as French private sector output was largely unchanged on the month. More excitement. We're unchanged.
More excitement, but yeah, I guess you see it reflected in the euro. We're slightly higher, though it did test its 55-day moving average earlier in the session. Dollar weakness has been a key theme. Maybe these strong PMIs, if they continue to roll in across Europe, will be something that will change that.
We'll look for more data a little bit later on. Remember, Lagarde's going to be speaking as well over the next few days. We'll watch her, along with all the other central bankers that are going to be giving us commentary on what is happening in the world right now. Somebody else that's been giving us commentary on what is happening in the world right now is Oaktree Capital's co-chairman. He, of course, is Howard Marks, and he's warning that US stocks appear to be in the early days of a bubble. Mark spoke exclusively with Bloomberg about his concerns over rising valuations and investor complacency.
This is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen. Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days.
97. It's interesting that actually Thorsten Slock yesterday put us at 98. He put us at late 98, I think. I don't know. How do you pick these things? It's hard to say. I think what he did say there was just interesting is that there's this kind of bias within the market to continue doing what has worked until it doesn't. Mm-hmm. But nobody believes that it's ever going to get to that point. You just continue going. Calling whether we're 97, 98, 99. The party's going to finish at some point. I don't know whether the party's just getting going.
But it's
like
not getting close to midnight, right? That's what they're saying.
I think probably most good parties don't end at midnight. They end at 2 a.m. I'm just going to point that out. I.e., they go way beyond where they probably should finish, and that's kind of the point. I don't know. How do you call this one? It's hard to call. There are some metrics that say we're beyond 2000. There are some metrics that say we're in the early days. It's what he's saying is that the market cannot conceive of a different world than the one that we're in at the moment. It cannot conceive of mean reversion. It cannot conceive that things change into a different operating environment. And that does feel like it does resonate at the moment. Nobody can quite get their head around the fact that stocks don't go up. And always will continue to go up. That seems to be the narrative that has existed for a long time, and people don't believe that that's going to change anytime soon.
Yeah, but I think this week people have gotten a bit more sensitive to this negative news that we've seen. Even take it what happened with Meta, restructuring their AI organization and having a hiring freeze. At some time.
Do you still buy the dip?
Well, they did yesterday.
My point. My points exactly.
All right, moving on to some European auto stories. Volkswagen pivoting once again on its bet on electric vehicles. The automaker had set its ambitions on selling more EVs globally than Tesla by this year, but that was back in 2021. Let's get more from this story on Bloomberg's Global Autos editor, Craig Trudell. Thanks for joining us this morning on this Volkswagen story. They set out some big ambitions, put a lot of money behind it. What's changed now?
Yeah, I think we can sort of rule out the likelihood that they will outsell Tesla globally this year. They will, however, they are on track to pull back ahead of Tesla here in Europe. They are getting some momentum, at least in some regions and with some models. Do they have a sort of smash hit EV like a Model Y? I think it's safe to say they do not. And it's really been an up and down decade, right, where you had some real issues with trying to replicate what was working for Tesla with throwing a lot of money and a lot of people at software. And it turns out you need more than just that, right? You need to do software well. And I think Volkswagen is still very much figuring that out. And so we've seen some indications that parts of this vast group is going to pump the brakes a little bit on EVs, in part because of the issues they've had with developing software internally.
What do customers want to buy right now?
I think it's a complex question where there are still a lot of consumers who are reluctant, and I think we can look at Bloomberg Intelligence has been doing regular surveys where they find this very consistent reluctance on the part of consumers.
But isn't that kind of marketing 101? You give the customer. What is the customer asking for? You give them what they are asking for because ultimately they're probably going to buy it if you do that.
Well, and I think, we do get to this question of how much of this is consumer demand, some of this momentum, versus how much of it policy, right? And it is the case that so much of the European market is company cars, right? And so there's maybe, you get a option of sort of a menu of cars presented to you by your employer in some cases. Sometimes you don't have a choice whether or not you go electric, right?
Right.
And so
that's still a thing. I thought company cars had long.
It's still very much a thing in Europe, and it's something that really sort of Americans, have trouble grasping that. But in China, right, I think it's a different story where we are still seeing serious intervention on the part of governments. But we're also seeing legitimate consumer demand of people wanting to go out and buy a Xiaomi, wanting to go out and get a BYD. And they're doing that because, the range is great. The charging, experience, it's sort of closer or at least getting there in terms of an equivalent to fueling up. And that's attractive to a lot of people.
Val's in the market for a new car.
I am in the market for a new car. If you have any recommendations for a mid-size SUV, I'm all ears. But what's Volkswagen's plan moving forward? Are there big ambitions just going elsewhere?
I think in China it's going to be very interesting that they're really going the partnership route. I think in terms of software, there's a consistency there as well, where they were trying to stand up an internal software effort called Cariad that has really been just sort of an unmitigated disaster. I think in the U.S. it's going to be interesting as well, where trying to, you mentioned being in the market for an SUV, they're really trying to go more in the direction of where the American consumer is, which is pickups and SUVs. The question I think
see
though
you in a
is
pickup.
Large cars.
I could see
whether
you.
or not, whether or not people want electric trucks or SUVs is still
another question. Yeah, that's right.
Yeah, they don't fit in London. We have this debate constantly. It's a struggle. Craig Trudell, very nice. Thank you very much indeed. Coming up, we're going to talk about the data. Jennifer McKeown's going to join us. That's next. This is Bloomberg.
Welcome back to the opening trade. We're 30 minutes into the cash equity session, but the focus is now on the PMIs. After we got better than expected French PMIs and got a boost in the euro, we're now looking at the German numbers dropping. Composite PMI rising to 50.9. The forecast was for 50.2. So better than expected PMIs out from France and from Germany. Remember, this data is the first data prints that we're getting from when those higher reciprocal tariffs were hitting the Eurozone economy. And so far, it is looking pretty good. Euro headed towards session highs, but trading flat on the session. Guy?
Let's talk about what is happening out there in terms of the market moves that we are watching. not a shock that you see this number. 54.5, negative 54.5, i.e. volume is pretty anemic today. In terms of the market move, we're pretty balanced. 241 up, 333 down. Defence is doing a little bit better. You are seeing some of the tech stocks still a little under pressure this morning. I tell you where you are seeing a bunch of 52-week highs today, and that is in the insurance space, which I think is quite interesting. Aegon is hitting a 52-week high. The Dutch insurer is up on the year by 18%. Let's call it 18%. Spike here that you can see to the right-hand side of the screen on the back of the earnings. This is propelling this stock sharply higher this morning. This earnings report that we've seen this morning, better than anticipated. But the entire sector is doing a little bit better this morning, and Aegon certainly the catalyst for that. That's the 52-week high. There aren't many out there this morning, many exciting ones, at least that we're watching carefully. What else do we need to know this morning, Val?
Well, here's what else you need to know on this Thursday morning. Federal Reserve Governor Lisa Cook says she won't be bullied into stepping down from the central bank. This is after President Trump called for her resignation over allegations of mortgage fraud. No charges have been filed against Fed Governor Cook. And U.S. Vice President JD Vance says negotiations over ending Russia's war in Ukraine are focused on security guarantees for Ukraine and territory that Russia wants, which include some land that's currently under Ukraine's control. Meanwhile, it's reported that Russia's foreign minister says Moscow and Beijing must be included in any Ukraine security guarantees. And lastly, the UK's budget deficit shrank more than expected in July as a deadline for paying self-assessed income tax boosted the Treasury's coffers. Spending exceeded revenue by £1.1 billion compared with £3.4 billion a year earlier. It was the first year-on-year decline in borrowing since November and the lowest July borrowing for 3 years. Guy?
OK, let's go back to some of the data that we're watching. We'll come back to that UK story in just a moment. I just want to reference what is happening with the German data this morning and the French data that we've seen in terms of the PMI numbers. Better than anticipated. And this was when we were suffering as well from the uncertainty around what the tariff story was going to be delivering. So actually, you put that into the mix, and maybe this data does look significantly better than anticipated. We'll come back to the UK borrowing story as well. And, of course, we've got to talk about what is happening at Jackson Hole a little later on this week and the lessons we're going to learn there. Jennifer McKeown, Chief Global Economist at Capital Economics, joining us around the table this morning. Good morning.
Good morning.
Better data out of Europe. Shall I get excited?
Well, no, those are very small. Those are very small moves, right? And we're still looking at PMIs, hovering around the 50 mark, which is supposed to be consistent with no change in GDP. Yep. So it's nothing to get excited about, but it's a bit of a relief. The big news since the previous PMI has been the trade deal, which is a bit disappointing, that 15% tax. So it could have been that you saw a worse effect. We saw both the Centix and the ZEW surveys deteriorate a little bit this month. So it could have been that followed through to the PMIs, which are more relevant for activity.
If I'm Christine Lagarde, I'm looking at this data. Do I think policy is in the right place?
Yes, I think so. I think the Eurozone feels a bit like an economy at equilibrium at the moment. That's always a risky thing to say, but with growth at 0.2%-ish per quarter, inflation around 2%, interest rates around 2%, I think I'd feel fairly comfortable. I mean, not excited by it. You'd much prefer, obviously, the growth was a lot stronger. But, it's the Eurozone. It's not grown strongly for a long time, and things feel broadly stable.
But, Jennifer, at the same time, this manufacturing print, we're nearing expansion, and it's the best print that we've seen since the middle of 2022. And this is an economy that's supposedly buckling from tariffs. Do you think that kind of flies in the face of this narrative that tariffs are going to have an impact on the economy when German manufacturing seems to be doing okay and slightly rebounding?
Yeah, I mean, it's early days, and I think the caveat there is you said nearing expansion. That's hardly
49.9.
Clearly, the Eurozone is still suffering a very long hangover from that sharp rise in energy prices. But tariffs don't seem to have had a disastrous effect on the Eurozone economy. It's early days. We'll need to see what happens, and particularly what happens with pharmaceuticals and so on. That's going to be really important for some European economies. But so far, so good, really, in terms of tariff impacts on the Eurozone.
What's the next big catalyst in your mind? Is it a potential peace talk with Russia and Ukraine, maybe denting the oil price and helping some of these German companies out? Or is it more on the trade deals. You know, we still haven't had a clarification on those pharma tariffs or on the semiconductor tariffs. What's on your mind as the next catalyst?
Yeah, well, not really Russia-Ukraine, to be honest. We don't think there's a really big risk premium priced into the oil price, and neither do we see big flows of gas resuming, even if there is a ceasefire from Russia to the Eurozone. The Eurozone has pulled back from that. There are clearly serious risks associated with relying on Russia for gas supply. So it's unlikely that you're going to see really major changes in commodity prices related to that. That said, we do expect the oil price to fall off a bit as OPEC Plus raises its production, so that should be something of a boost. And also we've got defence spending still coming through in Germany, which as that materialises, that should start to boost the economy somewhat. So those are the positives. The potential negative is those tariffs on pharmaceuticals, which we'll see what happens later this year.
So I'm bringing a story about the UK data this morning. And I'm going to quote from it. According to Alex Kerr, UK economist at Capital Economics, July's undershoot, quote, is not as good as it looks. And even if it is, and even if this undershoot persists, the Chancellor will probably need to raise taxes by 17 billion to 27 billion in the budget later this year. If the Chancellor raised taxes, it's hard to answer this question, but what are the implications? She's raised taxes before on employment. We've seen the effect. Yeah. She's changed the non-dom rules. We've seen the effect. If we further push up tax rates in the UK, is that growth negative?
Yes. Well, yes. Tax hikes need to be negative for growth, really. But the alternative is to let this slippage continue, and then more than likely you get a reaction in bond markets, which again is going to be negative for growth. So the Chancellor's stuck between a rock and a hard place.
So negative for growth and negative for growth?
Yes.
So the outlook for the UK economy is quite negative, one should assume.
Yes. I think it is fairly negative given the fiscal position that we're in. We would expect some growth in the UK, and we should have the effects of previous rate cuts still coming through, more interest rate cuts.
How sensitive is the UK economy to rates at the moment?
Quite sensitive. The mortgage market is more sensitive than in the US or in Germany, for example. So that should do something to boost the economy, to support the housing market, but offset by this ongoing fiscal tightening, unfortunately.
Yep. Do you see what's happening in the UK as a real kind of doom loop scenario of what happens when government
I hadn't gone quite that far. Doom loops. You're not getting into doom loops.
What happens when government debt gets too big? And, you know, like what we had last week, we had better than expected GDP data, which is great for the Chancellor, but then yields rose that ate into her headroom. I mean, she really can't win in this scenario. And in my mind, is there really any way out?
Well, growth really is absolutely the way out, and the hope that those
real growth, not nominal growth.
Real growth, absolutely, yeah. So the hope that those interest rate cuts do start to have an effect, that inflation starts to come down. I think that the real risk, well, a really big risk at the moment, is that the increase in taxes on employers and the increase in the minimum wage feed through further to wage growth and to inflation expectations, keep inflation high, then we can't get the rate cuts from the Bank of England that we're all hoping will continue, and that would be a real blow. But on the other hand, if those effects are temporary, if those interest rate cuts continue, then I think that should be really helpful, and that could
How are you thinking about the division at the Bank of England? It's really surprising, and, you know, I mean, hardly any central bank has this kind of division, and the chair, Bailey, still exists in some way. Why is there no calls for Andrew Bailey to step down in order to try to get some sort of better clarity on where the Bank of England is going?
Well, you know, the reason that you have large committees is so that differences of opinion can be expressed, and it's very clear that things are unclear in the UK, that things are uncertain. On the one hand, you have these persistent price pressures, but the economy is really not faring well. So I think it's no surprise that there are divisions. It's really interesting that we had that second vote for the first time. It would be interesting to see whether that happens again in future. But I don't think that this is really a sign that the bank is performing poorly. It's just a sign that there is a lot of uncertainty at the moment around the economic data, and I think we're going to continue to see these divisions.
It's Jay Powell. The title of Jackson Hole is all about the labour market and the transition. There is a view that maybe the hint there is that Jay Powell is going to transition to a new view on the labour market. Is that what you're expecting?
No, not really. I think it's very likely there will be more emphasis on the labour market, just given the data that we've seen.
Yep.
And we know that the Fed explicitly has this dual mandate where it needs to look at the labour market too. So and that, I think, will be emphasised. But on the other hand, the inflation risk, the stickiness of inflation, the recent rise in services inflation, which suggested that maybe when the Fed was worrying about the tariffs and goods prices, it had been looking in the wrong place. I think those are two sides of the coin, which Powell's going to need to express, and will need to walk a very careful line between not implying that that the labour market downturn is by far the more important thing.
I do wonder if he's not overtly dovish, whether he's perceived as being hawkish.
Yeah,
that does seem to be the risk that maybe.
I think he might be. Yeah, he might be, and I think the greater likelihood is that the market movement is in that direction after his speech, in the hawkish direction, in my view, because I think he'll try to be very balanced.
Great to see you. Thanks for stopping by to see us. We really appreciate it. Jennifer McKeown,
you're welcome.
Chief Global Economist, joining us from Capital Economics. Coming up, retail earnings in the spotlight. We've got disappointing sales. We got a disappointing sales outlook from Target yesterday. The big news, actually, in some ways, came in terms of senior management changes. We have Walmart coming up. That's the big one. We'll talk about it next. This is Bloomberg. Welcome back. You're watching the opening trade. 45 minutes into the equity market session, and I have nothing to report. As you can see, equity markets are going nowhere in a hurry. We're waiting for the next catalyst. What will that catalyst be? Could it be what happens around the Ukrainian situation? Could it be what happens out in Jackson Hole? We will wait and we will watch, but we don't have any clarity on any of that subject now. It does so. The excitement, and I think where we are seeing some action this morning is in defence stocks, and I do feel that is a reaction to maybe actually the Russians pouring a lot of cold water on the idea that, A, we're going to see some sort of Zelensky-Putin meeting. And I think Zelensky's setting out some sort of criteria for that as well. So I think that feels like it's a more distant prospect. But also this idea of some sort of security force operating in Ukraine to provide guarantees for Ukraine appears to be further away now than maybe it was. And that feels like something that basically puts us back to where we were before. The status quo is maintained, the conflict continues, the ordnance being used at the moment that is being provided by the United States and Europe is going to continue to flow into that country. That in some ways is good for the defence companies that we see on our screens in front of us. Rheinmetall, BAE Systems, names like that, doing relatively well this morning.
Yeah, I guess still a lot of questions to be answered on these security guarantees that Witkoff mentioned to the press on Sunday. And I think that you can kind of see that in the market reaction this week. You know, I thought maybe we'd have some big surprise, big breakthrough, big drop in oil, big rise in the euro, and it's not something we necessarily got.
Definitely not getting that right now. It's interesting, actually, because the other thing that the Russian Sergei Lavrov has suggested over the last 24 hours is that maybe China would be involved in any kind of security guarantee for Ukraine. Now, this morning, the Ukrainian President Volodymyr Zelensky very much pushing back on the idea that China could be added as a security guarantor in terms of a ceasefire. Not actually, interesting enough, ruling out Russia, but I'm assuming that's kind of, that there's a sort of tacit read on that. Zelensky says he needs security guarantees only from those countries that are ready to help Ukraine. Does that rule out Russia? One would have to assume so. Joining us now is our Brussels bureau chief, Suzanne Lynch. Suzanne, where are we on this idea of a security guarantee? We heard Witkoff over the weekend talking about the fact that the Russians had accepted the idea. The Europeans have been running around trying to sort one out. And now you've got Lavrov basically saying, yeah, we want to be involved and the Chinese want to be involved. And you do wonder, therefore, whether any security guarantee is actually worth the paper it's written on. Where are we?
Yes, I mean, these statements by the Russian side, in one sense, are not a surprise that they were going to respond to this idea of a security guarantee in this kind of way. But it's obviously really a non-starter, the idea that Russia would be involved in dictating the terms of a security guarantee when they are the aggressor that these European allies are trying to protect Ukraine from. So that's one issue. Secondly, this issue of China being involved, this is an interesting point. There have been whispers of this over the last few years since this full-scale invasion of Ukraine by Russia. Russia and China, obviously, something of two allies when it comes to, for example, the UN Security Council, when they meet there. But again, the idea of Chinese troops or Chinese presence in Europe, which is what this would mean in reality, is something I think that will be rejected by European allies. But of course, it's not just European allies, it's the United States too. They're also a member of NATO and they're part of these discussions. So, you know, there will be questions asked about how much traction this might get in Washington. But ultimately, no, here in Europe, what they're looking at and what they're trying to scramble to put in place is some kind of a system, NATO-light, that they would be there to try and help and back up Ukraine with the help, they hope, of some kind of US involvement.
All right, that was Bloomberg's Suzanne Lynch joining us from Brussels on the latest on Ukraine-Russia developments. Let's take a look at some other catalysts that we do have on the docket for you today. We do have some more global flash PMIs. The Eurozone numbers drop at 9. We also have the UK numbers at 9:30. And then later today, U.S. jobless claims. We also get Walmart earnings before the bell. And the Jackson Hole Symposium begins later today out in Wyoming.
Well, let's pick up on that retail story. Busy week. We always get it kind of towards the end of the earnings season. It's the retailers that come out, the big box retailers out of the United States. We've had a few already. We got a disappointing sales outlook from Target yesterday. Today, though, is the big one. Walmart is on deck, and Jennifer Creary is here to give us a sense of what we could learn. Such a useful tell on what is happening, in retail, what's happening with the tariff story, what's happening with the U.S. economy. What are we going to learn? What should we expect to learn from Walmart today?
Yeah, so it's been a real mixed bag so far for retail earnings. So far, we've seen some of the stronger results. TJ Maxx, for example, performing very well. They raised their full-year earnings per share guidance, and that's thanks to its value proposition. So the lesson we can take away from that is that customers are really looking for value, so it's a good time to be a discount retailer. Perhaps some of the weaker results. So Target, for example, the big news coming out yesterday that it replaced its CEO, and that's in an effort to really turbocharge its turnaround. And it's having to manage some higher costs, as all retailers are, relating to tariffs. And so the big one today, Walmart, analysts are expecting a pretty positive read on it because of its really tight inventory management. And, as you mentioned, it's seen as kind of a barometer for U.S. consumer sentiment. So that's one that investors will really be keeping an eye out for today.
Jennifer, what have these results told us about how these companies and how consumers are dealing with the hit from tariffs?
Yeah, I mean, no retailer wants to raise their prices, but we're already seeing that bleed through. So Home Depot, for example, Target as well, saying that they'll potentially have to raise prices. Walmart as well warned in the previous quarter that they're going to have to raise prices on certain products, including baby products, for example. But we're also seeing evidence of some retailers trying to manage those costs, swallow those costs, either by negotiating lower prices with some of their suppliers, which Target mentioned in their results. And so it's a tricky time for retailers, but they're going to have to try and keep costs low because we know that customers are looking for value.
All right, that was Bloomberg's Jennifer Creary giving us an overview of these retail earnings that we've got this week. A bit of a mixed picture, but I like what she said there about some of these retailers warning that they'll have to raise prices in the future. No one actually saying that they've raised them already.
Yeah, but it's coming, and inflation's already inflation's ticking up, and we haven't raised prices yet. Is that
still beating through that inventory, I guess?
Yes.
But moving on to Jackson Hole, it kicks off today in Wyoming. Joining us now to discuss is Bloomberg senior strategist Neil Campling. Traders are still expecting this rate cut in September. Are we going to get that solidified by what we hear from Powell tomorrow?
I think the message from Powell tomorrow is going to be the same message that he's had before, which is trust the data, wait for the data. And I think that's going to be the ongoing message.
Doesn't sound very dovish to me.
I was about to say, this is the debate this morning, okay?
Absolutely.
So if it's not dovish, it's hawkish. Seems to be the tone. And if it's hawkish, then the market's not going to like it. Is that the kind of...
Well, I think we're going to get probably the social media post from somebody in the White House saying too late Powell again, aren't we? In one sense, I think traders, when talking to clients this morning, actually, I think the message back is that the short-term message is actually less important. The longer-term message is going to be, look, we've got at least 3 seats that are coming up, and we've probably got 11 candidates now, and it's a question of the most dovish of those candidates are probably going to likely find themselves in the seats within the Fed.
If you're managing a P&L, though, right, are you worried about the long term, or are you worried about the short term?
Well, I suppose, if you look at what equity clients are talking about, they're saying that what we've seen so far is the huge kind of V-shaped recovery we saw since the April dip is an even shorter V-shape than we had after COVID.
They get shorter and shorter.
They get shorter and shorter. And so now we're in a situation where you've got so many kind of mixed messages that are out there. There's also the question about, what do we see within the data itself?
So there'll be an I-shaped recovery. You can't actually tell the difference between. There's no gap between the two.
5 seconds of a dip.
We're going from months to weeks to days at this rate, to hours even perhaps.
But I have a question. Powell needs to change the way that he's characterized the labor market. He characterized it previously as solid. Do you think he's going to use that same language tomorrow? And if he doesn't, what else is he going to say? Is he going to sense that the labor market has weakened?
I mean, again, I think, and you've just been talking about retail earnings, for example, and the messages you're getting from the corporates. Well, we haven't seen it come through yet. And actually, we look at the PPI data. Again, we haven't seen it come through yet, as in they're not passing through the costs. So only two things can happen then, if you think about it slightly longer term. We either have to have margin compression, or we have to have job losses. So even if he takes out the word about the robust labour market, I think he's still going to say, look, core PCE, which is what they care about, is still hot.
It is still, it is. But here's the bit that I can't figure out, OK? It feels like the market wants a slowdown. And the market wants the labour market to weaken, so that Powell can say that it's weakened, so therefore we can get rate cuts.
Rate cuts, which is great for growth and is great for stocks. And
but isn't a bad labour market bad? Isn't that the kind of the concern?
No, we want it to weaken slightly, not fall off a cliff. But history does tell us that once the labour market starts to weaken,
that's my point.
It does
Careful
fall off
what you
a cliff.
wish for here. You want a labour market that's slowing so Powell can cut rates,
but then they come in and do QE again, and everyone's happy.
Yeah, exactly.
We all know that playbook.
And again, if the cut, and I don't think it will happen, but if the cut was 50 basis points rather than 25, what message does that send?
Yeah, exactly.
The data we haven't told you about yet is really bad. So what do you want? I mean, the other thing is, if we look back at the 2Q earnings season, it's quite clear that tech was the heavy lifter for the whole of the S&P earnings. If you go slightly down the market cap level, then we had near 9% earnings growth for small caps. When we was expected a 3% decline. Now, small caps really, at the end of the day, are the lifeblood of the economy. So it's not showing up in that data yet either. So we've got so many mixed messages that, I think...
Which ones are you listening to?
Oh, I listen to all of them, obviously.
Look, I mean, given the theme of Jackson Hole as a labour market in transition, and then it does discuss immigration within the subhead of that, I'm looking for a big update on what Powell thinks that immigration is going to have on the U.S. economy. Is it going to be a weaker labour market, or is it going to be weaker growth? How is he looking at it?
But you can have an unemployment rate that's stable.
Exactly.
And a labour market that is producing 75,000 jobs a month. Yeah. That feels like stability to me.
It's not off a cliff, is it? We're not talking about a kind of COVID-type situation, or even with all the uncertainty around tariffs. And we've had some pretty worrying data again this week from some of the corporates, like Toll Brothers, James Hardy. The housing market's not great. Construction, retail numbers, etc. I mean, there's a lot of mixed messages.
A lot of things out there to listen to. Anyway, that wraps things up for us. The Pulse is coming up next. Enjoy the rest of the day. Friday's going to be a big day. This is Bloomberg.